Welcome back to the Investing Markets and Money podcast. And this week, we're actually making a podcast that earlier stage investors may find useful. I'm talking about some of the basics of getting into the market, particularly if you are a UK-based investor looking at potentially getting involved at some level. And to talk us through some of the options available, we're joined today by Richard Hunter, who's joining us from Interactive Investors in London. Welcome to the podcast, Richard.
Good morning, and thank you very much for having me here.
So I wanted to start off with the fact that you actually won an award from us in the Online Money Awards, where you collected the Best Investment Platform Award. So I just wanted to ask you a little bit about Interactive Investors in particular, because some people may not be familiar with the company or with the investment services that you currently offer.
Sure. Interactive Investor was formed in 1995, so we're in our 30th year of operation now. Used to be called a stockbroker, but these days, of course, it's an investment platform, given the kind of access and bent towards technology. But basically, if you want to buy or sell a share, buy or sell a fund, we're probably one of the biggest two, if not top three, brokers or investment platforms in the UK. We like to think we've got two main differentiators. The first is that in traditional terms, fees tend to be charged on a percentage basis, or what used to be called an ad valorem basis. So if your portfolio went up in value, good for you, but so would your charges. We basically charge a flat fee. So if your investments do go up in value, that money is money that you keep, and you will be paying us the same. And the other thing that differentiates us, and perhaps less financial, we've got a lot of very keen people dotted around the business who are jargon busters. So we very much recognise that this is an area which people can be nervous in entering. And so as far as possible, and we are, of course, guilty as an industry of using jargon too often, as far as possible, we do try to very much cut that down and keep it simple.
That's actually still a big issue for many people looking at the finance industry or investing, is the jargon can be quite intimidating. But in terms of, if we take someone who hasn't actually got any money directly invested themselves, other than potentially, in a company pension scheme, why should they be looking at investing? What's the argument in favor of it, rather than sitting there with all your money in cash?
Well, in terms of the cash part of that equation, what people often forget is that interest rates have been higher for a bit longer now. So let's just say, for argument's sake, you're getting 3% on your cash. What people often forget is that inflation is running at nearer 4%. So, in 100 years' time, the £100 that you've stuck under the bed is probably worth £70 in real terms. So effectively, you're losing money by keeping your money in cash. I think the other thing to say is, if you go back 100 years, there's a thing called the Barclays Equity Gilt Study, which has been going for some considerable time. And the performance of equities over the long term compared to cash is exponential. So, of course, there is an added element of risk. But if history is anything to go by, there is certainly very much an added element of reward.
Understood. And what sort of structures are available to UK-based investors particularly? Because obviously there's a number of quite tax-efficient avenues that you can use to invest with, using platforms, for example, like Interactive Investor.
Yeah, I mean, the obvious one is an ISA, individual savings account. This shields you from tax on any capital gains that you make or any income that you might make on dividends. It may or may not get reviewed and simplified over a given time, because at the moment there's a number of ISAs that you can choose from. A stocks and shares ISA, which is fairly self-explanatory, as is a cash ISA. But there's also a lifetime ISA, which is designed to kind of encourage people to save up and get on the the property ladder for the first time, and a junior ISA, which you may want to start saving at a very, very early stage for a child or indeed children. These usually come, these tax efficient wrappers usually come with some kind of kickback or additional contribution, if you like, from the government. So that's something you should find out, because that varies between ISAs. And probably the other thing to mention is a SIP, self-invested personal pension. This is very much money that you run yourself for the long term. Again, there's a government contribution. You can't actually withdraw the money until you're 55, after which I think you can take the first quarter of your pot free of any tax whatsoever. After that, it'll be treated as income. But nonetheless, as I say, as it's going forward over the years, it's also a very tax efficient wrapper. So again, ISAs and SIPs are simply wrappers where you would want to hold your investments to shield them as far as possible from tax.
And when people are looking at investing for the first time, do they tend to, I mean, like looking at your clients, for example, do they tend to buy funds? Do they tend to buy stocks? Do they tend to buy a mix of the two? I mean, what do beginning investors tend to get access to?
I think it's fair to say that if the company you work for is a quoted company, you can often find yourself exposed to shares for the first time by a kind of save as you earn scheme, which is over usually a 2, 3 or 5 year period. And that would mean that you're obviously holding shares in that one company. But it's a useful educational tool to be able to dip your toe in the water. I think the more traditional way in for most investors would be via a fund, simply because a fund, of course, is a basket of shares which may relate to a country or a sector. And that effectively means that in terms of what's called active funds, that portfolio, you just buy one fund, and underneath that there might be 30 holdings, but that active portfolio is being managed by a professional investor. So for the sake of one investment on your terms, someone else is looking after it. There's also recently been a rise in the passive sector. They're called exchange traded funds, but they're not as complicated as they sound. What we now have the ability to do, which we probably didn't a decade ago, is if you like the look of the states, you buy a US tracker, or China, a Chinese tracker, or the FTSE 100. But you can also slice and dice them, again, by sector, or perhaps an area of the market that you think has got something to go. So traditionally, because of that spreading your risk, if you like, investors would enter the market via funds rather than direct shares.
So it would be tendency to build up a portfolio of funds initially, and then maybe look at some shares further down the road once you're feeling more confident.
Absolutely. And it may well be, of course, that, again, depending on where you work, you may have particular knowledge of your sector, which gives you a real insight into what's happening in your sector, where the opportunities might lie. And there's nothing wrong with using that additional knowledge to be able to invest in such shares.
That's a very good piece of advice, actually, because people don't realize if you work in a particular sector, let's say you're working in engineering, you'll understand who the companies are and their product set much better than anyone other than, specialist analysts, I would guess, in that respect.
Yeah, absolutely. And you'll, one assumes you'll be networking, you'll be knowing what's going on in the business, you'll be knowing who's doing well, you'll be knowing about the new developments that are coming through. And that's a fairly privileged position to be in. So some investors will look to take advantage of that.
And can you provide a little bit of insight into the sort of information resources that the Interactive Investor itself provides for early stage investors on your website?
I think, there's a raft of information, and we very much go from the beginner to the expert. We've recently launched something actually called Investment Coach. So this is bite-sized videos, bite-sized articles, etc. You do a short survey which gives us a picture of A, your attitude to risk, and B, your experience, and the content is tailored accordingly. From a broader perspective, we do news analysis and research on a whole host of funds and indeed individual shares, as well as daily commentary either on the market itself. We speak to fund managers, we speak to other industry experts. So apart from the written word, there's a raft of podcasts, videos and so on, which investors or indeed viewers can dip in and out at at any time they choose.
And I wanted to talk to you a little bit more about diversification. Again, people may not understand really what that is. What does I've been writing about asset management for 30 years, and even at the top level of asset management, when you talk to hedge funds, they talk about diversification a lot, and you can see when professional fund managers get it wrong, it can turn fairly horrendous. But from the perspective of the early investor, why is diversification important, and what should that look like?
Well, it's all about not putting all of your eggs into one basket, to use the trite old saying, which holds true even today. Just going back to our previous example, let's just say you're in the engineering sector. You've bought 2 or 3 shares in that sector. Let's say they've done very well. Your portfolio at the moment is totally based around the engineering sector, which is great until it isn't. So diversification is having exposure to other sectors. And there are sometimes some sectors which are called defensive, the likes of the utilities, gas, water, and so on, for which there's going to be demand regardless of what's happening in the economy. So it's always useful to have a spread of investments so that whatever outcome we find, even either in terms of the economy or other macro factors such as, the current trade tariffs and all the rest of it, you've got some exposure to lessen some of the losses that you might be taking on an individual stock or indeed fund basis. There's also another horrible word in the industry, which is within your portfolio, to keep the number of holdings that you have at a reasonable level. If you're sort of holding more than 30 funds or shares, that can be termed diversification, partly because you'll find that some of those shares and funds overlap, but also because you're giving yourself something of a full-time job to keep an eye on them all.
And the other issue, of course, is if some of your shares do incredibly well, you don't want that share to become too much of the value of your investment portfolio. And in fact, talking to my colleague Michael, he was having to sell some of his real winners just because they're the real winners at the end of the day, and he wants to keep that diversification within his own SIP.
Yeah, it's an interesting one because I think it's fair to say that it's much easier to buy shares than it is to sell shares. But when you're going in, you've done your research, you know the sector, you know the company, off we go, and I hope this is going to work out for me. If the price then rises, perhaps even more than you expected, you've got this horrible fear of missing out by selling them now, and off the price continues to go. But of course, it's never wrong to take a profit. And there are some things that you can do to mitigate that. If you're lucky enough, for example, to have put £10,000 in one share and it's doubled, it's now worth £20,000, you simply sell £10,000 worth of shares, leaving you 10. So you've covered your initial cost, and what you've left, you've still got skin in the game, and it's pure profit.
Yeah, that's very true. And can you tell us a little bit about the value of compounding as well over the long term? Because that's something that a lot of people aren't aware of either.
Well, I mean, I don't think it's ever been proved, but Einstein reportedly called it the 8th wonder of the world. This is basically, in simple terms, it's earning interest on interest. But over a period of time, it gets more and more powerful. You can do a simple Google search and look at it in terms of graph form. But when it really kicks in, which might be 10 or 20 years, it starts to accumulate at an astounding rate. And in terms of the SIPs or the ISAs that we mentioned at the top, if you've got dividend income which you're reinvesting into those shares rather than taking the income itself, that's part of compounding. And you'll find that over a period of time, as I say, when it takes hold, it really is probably the most powerful of all investment tools.
No, that's very true. And also, I just wanted to ask you a little bit about people who they want to be invested, but they don't want to be keeping tabs on their portfolio all the time. They may not actually want to buy actual individual stocks.
Yeah, I don't. I think it's fair to say that you shouldn't be checking your portfolio on a daily basis. Investment is meant to be for the longer term. So you should really be taking a 3 to 5 year view in any case. That's not to say, check it every 3 to 5 years. By all means, check it 3 or 4 times a year, because at any given time, you will hear so much noise coming out of the market. You will see headlines that when the market goes down 0.2%, shares have tumbled and wiped off £10 billion in value. But you'll rarely see the headline, shares are up by 1.1% today, and £20 billion worth of value has been added to your investment. So at any given time, there's a lot of noise around, but bearing in mind that you're in this for the longer term, unless anything cataclysmic happens to your fund or indeed share, it's a question of just making sure now and then that the reasons that you bought it are still in place.
No, that's very true. And someone who doesn't really want to get involved in the decision making themselves, what are the options available to them?
Ultimately, of course, you would approach a wealth manager who you would pay a fee to on an ongoing basis for them to manage your portfolio in its entirety. But on the basis that the industry is now trying to become a lot more approachable, there are a great many investment tools out there. And in much the same way that you invest money, you need to invest time. And a few hours spent having a look at a website in terms of whether it's a beginner's guide, just starting to do a bit of reading, perhaps starting with what used to be called a paper portfolio or a virtual portfolio, just to see over a period of a few months how you get on, where you're doing well, where you're doing not so well. It really is not the arcane business that it was 30 years ago. And it's also understandable in its simplest form, as it should be.
And just really to finish off, Richard, can you tell us where people can find out more about interactive investors yourselves and the information we talked about?
Sure. Yeah, ii.co.uk. It's as simple as that. You'll be confronted with a homepage. There's a news section underneath which you'll see all the daily analysis, the market analysis and so on. But it's also very easy to find on one of the drop downs from the top, the beginner's guide and how you might actually take that important first step.
Fantastic. Thank you very much for joining us on the podcast today, Richard. That's been really informative, especially for our earlier stage investor listeners.
Absolute pleasure.
The content of this podcast is for information and entertainment purposes only and does not constitute financial advice. The views and opinions expressed by guests or hosts are their own and do not necessarily reflect those of the armchair trader. Investments can go up and down in value, and you may not get back the amount you originally invested. Past performance is not a reliable indicator of future results. We do not provide any personal investment, tax, or legal advice. Always do your own research or seek independent professional advice before making any financial decisions. The Armchair Trader is a media company and is not authorized or regulated by the Financial Conduct Authority.